Welcome to Early Age Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stocks chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
The company that we are analyzing today is Creative Graphics Solutions Ltd. So let's see the company. So Creative Graphics is a leading player in the pre-press industry. It was founded in 2001 and recently got listed on the NSE SME platform in April 2024. The company primarily operates in three key business segments. The first is its core business of flexographic printing plates, which are essential components for printing on packaging materials for a wide range of products, from consumer goods to paper cups. The second is its fastest growing segment, and India subsidiary focused on pharmaceutical packaging. It specializes in high quality cold formed blistered foils, which are critical for the pharma industry. The third is CGP Premedia, another subsidiary that provides Premedia services like artwork, mockups, and 3D pack shots, serving major clients like ITC, Tata Consumers, and Dabur India. The company's diverse business model positions it well to capture growth across multiple sectors. Now let's take a look at the industry that our company operates in. We have seen that the company has a strong presence in both the printing plates market and the pharmaceutical packaging market. First, let's look at the printing plates market. So the global printing plates market is large and growing industry, which is projected with a projected market size to reach around $20 billion by 2032, expanding at a CAGR of around 4%. The key growth drivers for the market are the overall growth of the packaging industry, especially for food and consumer goods. The booming e-commerce sector relies heavily on flexible and innovative packaging. Most importantly, the shift towards sustainable and eco-friendly packaging solution is a core benefit of flexography. Regulatory pressures such as government's extended producer responsibility (EPR) norms are pushing companies away from traditional gravure printing towards more sustainable option, which directly benefits our company's core business. So moving to the pharmaceutical foils market, this is another high growth area. The global pharmaceutical foil market is projected to reach over $5.8 billion by 2033, with a CAGR of more than 6%. The growth drivers for this market are the rapid expansion of the global pharmaceutical industry, particularly in emerging economies, increasing demand for high quality, safe packaging that provides excellent barrier protection and extends the shelf life of medicine. The growing use of blister packaging, which is crucial for unit dose medication, and the need for tamper-proof and authentic packaging solution. This dual presence in both of these high-growth industry provides Creative Graphics with a well-diversified and robust growth trajectory. Now, let's see our company business by business. So, Creative Graphics, the main company. So, it is a flexography printing plates business. So, the flexography printing plate business is the company's foundation. These plates are crucial ingredients for printing on a wide variety of flexible packaging materials. The market for printing plates is projected to grow significantly. Creative Graphics is a market leader in this space. The company is strategically capitalizing on these trends. It's expanding its footprint with two new factories, including first international facility in Oman, which it sees as a gateway to the entire Middle East and African markets. This is a smart move to service clients more efficiently. And as you can see, these are the products which they are doing: flexo printing plates, digital plates, letterpress, and coating plates. Next, we have CG Premedia. So Creative Graphics also operates through its Premedia Services subsidiary, CGP Premedia. This segment provides end-to-end pre-press solutions, including artwork creation, pre-press mockups, and even 3D packed shots. The Premedia business is a high margin service that compels the core flexography business. It helps the company to become a one stop solution for its clients from design and artwork to final printing plates. The CGP Premedia subsidiary already boasts an impressive list of clients, including major consumer goods companies like ITC, Tata Consumer, Mars, and Dabur India. This segment's reputable client list not only provides a stable revenue stream, but also enhances the brand image and credibility of creative graphics as a whole. Lastly, we have Warren India. So it is Creative Graphics' fastest growing subsidiary and a key part of its future strategy. This segment manufactures high quality Alu-Alu based foils, a specialized packaging material used for medicines. India has made a significant impact in the short period, building a client base of over 300 pharmaceutical companies, including big names like Torrent, Intas, and Zydus. The company has an existing capacity of 8,000 tons per annum and is currently operating at 70% utilization. It's adding another capacity expansion to meet the huge demand it's seeing, which will significantly boost its output and revenue potential. The company is also adding a PVDC and tandem extrusion lines, which were acquired at a very low cost, which will further diversify its product portfolio within the pharma packaging space and drive margins. Let's look at the company's leadership. Mr. Dipanshu Goyal, the managing director, leads the company. He and his fellow directors, particularly the founder promoters, have extensive experience in the flexography industry, which has been crucial in establishing Creative Graphics as a market leader. Their hands-on experience and deep industry knowledge are valuable assets for navigating market dynamics and identifying new growth opportunity, as seen with the successful diversification into the pharmaceutical and pre-media sectors. Now for the historical performance, the company has shown a remarkable growth trajectory. We have seen that both the top line and bottom line have grown significantly over the last few years. With a 3-year revenue CAGR of 45%, this growth has been particularly strong in the recent past, with the company's consolidated turnover and bottom line both crossing major milestones in FY25. While profitability has shown strong growth, we have seen some fluctuation in margins in recent periods. This can be partly attributed to increased operational costs and increased interest expenses related to company's aggressive expansion strategy. Now, key takeaways. The company's profile is undergoing a significant transformation. Just 15 months before the last con call, Creative Graphics was 100% focused on its flexography business. Now, the pharmaceutical packaging Warren India segment, which manufactures Alu-Alu foil, contributes 60% to the top line and 40% to the bottom line. And this ratio is expected to continue increasing. This highlights a successful and rapid diversification into a high growth sector. Next, while not providing specific financial guidance, management stated their intention to double their top line growth year on year. They acknowledge that this aggressive growth might not happen every year due to potential expansion delays, but it represents the overall strategic direction. Thirdly, the consolidated EBITDA margin for FY25 was around 15%. Core flexography business maintains a healthy EBITDA margin of over 18%, which management considers sustainable. The Warren India pharma packaging business, however, had an 11% EBITDA margin for the full year due to suboptimal average capacity utilization of just 50%. Management expects Warren's margin to improve significantly as capacity utilization increases, projecting mid-teen EBITDA margins for combined business over the next 2 years. Next, contrary to some perception, management emphasized that the flexography market is growing at a fast pace. This growth is significantly driven by the push towards sustainability and stricter extended EPR norms. Flexography's ability to utilize monolayer and recycled products makes it a sustainable alternative to multi-layer gravure printing. Major brands like Unilever and Tata Salt have already converted some gravure printing to Flexo, and the company is in discussion with others like PepsiCo and Maggi for similar conversions. The flexography business is projected to potentially reach 1,000 crores revenue in within 7 to 8 years due to this regulatory tailwinds. Then the company is adding two new flexography factories, as I mentioned. First is overseas facility in Oman, strategically positioned as a gateway for the whole of Africa and Middle East. This expansion are primarily aimed at improving geographical placement and client service to drive higher volumes rather than just adding raw capacities. As current flexography utilization is around 60%. Then Creative Graphics has strategically acquired valuable machinery, including a PVDC line and a tandem extrusion machine from a company which was undergoing NCLT proceedings at a very, very lower cost, approximately 10% of the cost of what in which new equipment comes. So this new lines are expected to add 100 to 150 crores in annual revenue for Warren India on full utilization. The com- Lastly, the company does not anticipate needing significant external debt for its growth plans as it has sufficient funds from its recent IPO, internal cash generation, and unutilized bank credit lines. Next case, so high growth market exposure. So the company is strategically positioned in the rapidly expanding Indian packaging market, projected to grow at a 10.7% CAGR to USD $169 billion by 2030. Its diversification into pharmaceutical packaging and pre-media services steps into even faster growing segments like e-commerce packaging and robust pharmaceutical export. The rapid growth and increasing contribution of Warren India business, 60% of the top line, 40% of the bottom line, demonstrate the successful execution of its diversification strategy. This moves into high barrier, high value pharmaceutical packaging, provides stability and resilience. Furthermore, the pre-media subsidiary strong client base, example ITC, Tata Consumers, creates cross-selling opportunity for CG for a company's core flexo plates. And then third, the increasing adoption of stricter EPR norms and a global shift towards sustainable packaging solutions are significant tailwinds for our company. Lastly, strategic and capital efficient expansion. So the company's approach to expansion, focusing on geographical placement to improve service and drive volumes rather than just adding capacity is a smart strategy. The ability to acquire high value machinery at a fraction of the cost through NCLT proceeding showcase astute capital allocation and a focus on maximizing returns on investment. Now the bear case. So while the doubling of revenue year on year target is ambitious, management's caveat that it might not happen every year highlights the inherent execution risk. Delays in capacity expansion as seen with the Bobster cluster machine or challenges in achieving optimal utilization in new facilities could lead to missed targets and revenue disappointments. Next, the increasing trend in working capital days, particularly due to the war and business stocking imported raw materials ahead of sales, could tie up significant cash and strain liquidity while operating cash flow is improving. Inefficient working capital management could higher borrowings or impact the ability to fund growth internally. Then third, potential for margin dilution. So while the flexography business enjoys high teen EBITDA margins, the Warren business operates at a lower mid-teen margins. As Warren's contribution to the overall top line increases, it could dilute the consolidated EBITDA, even if Warren's margin improve with utilization. This might cap the overall profitability expansion. Next, the stock is flagged as a bit higher in valuations. So a valuation will say in the end, but I have put it out just as a point here. But so we'll say it in the end. So a competition and financial stability. So while our company claims market leadership in flexography, it operates in a competitive landscape with both strong organized players and a fragmented unorganized sector. Some sources suggest the company seems to be less financially stable compared to its competitors, which could imply vulnerability to competitive pressures or economic downturns. Now let's see the company through our framework. So section one, fundraise history. If you see, they had raised 54 crores in March 2024. Most of it went to working capital and repayment of borrowings. Rest 10 crores were kept for capex. So because it was mostly for working capital and borrowings, I gave a 3 on 5 score. Director and promoter track record. So director MD Mr. Dipanshu Goyal only has majority of the holdings, and I did not find any bad remark about any of the promoters or directors of the company. So I gave a 5 score. Related party transaction. So there were some related party transactions, such as advance given to Warren India and everything. Because the amount was a bit big, so I gave a 3 on 5 score. Board independence, if we see here also there is a bit of problem because out of the 8 directors, only 2 are independent. Family on board is also 2, but still the number of independent directors should be much higher. So that is why I gave a 3 on 5 score. Remuneration, if you see, it is fine. It is what we consider a 5 score. So I give a 5 score back. There were no key person designation. There was no designation by auditor or change in auditors. Auditor opinion has been unmodified. Regulatory and legal issue were not there. So in all these 4 metrics, I gave a 5 score. Investor communication and disclosure. So PPT, only one PPT was there of August, and con call, they have recently done a con call. So one con call only they have done. So that is why I did not see the con call first. So that is why I gave a 0 on 5. But I think we should consider it 0 on 5 only because we'll have to see if they are doing con calls regularly or not. So that is why I gave a 0 on 5 score. Section 2, so business concentration risk. I did not find any major concentration risk in my research. So I gave a 5 score. Cash flow by EBITDA, if you see, it has very fluctuating, and this year it has gone negative. I think this is also because of war in India, because 60% of the top line is now coming from war in India. So that is why I gave a 0 on 5 score. Why I'm saying this? Because we have already done research on GSM foils and MMP industries. GSM foils is mostly doing the same business as Warren India, and it is a very working capital heavy business, and they need a lot of debt. And after all, after some time, it comes down to just who is able to give these pharma companies at a lower cost. So the margins get shrink very much. So it is a very difficult business, I mean, and a very working capital heavy business. So that is why the impact of that also we are seeing in this company's financials. If you see the receivables by revenue growth as a percentage of revenue, receivables have been growing, and it is around 30% only for the last few years. And year on year growth also, if you see it is high at 107%. So because of this too, I have gave a 3 on 5 scores. Inventory trends, if you see, inventory also been growing. Inventory growth is also happening mostly because they are collecting the aluminium and everything they are purchasing uh, in ahead of the time. So, and that is why inventory days is increasing, and cash conversion cycle is also increasing at a very fast pace. So that is why I gave a 3 on 5 score in both these metrics. Capex by revenue is fine, so that is why I gave a 5 score. Debt to equity, if you say, debt to equity ratio has come down, but it is still a bit high to give a 5 score for us. So that is why I gave a 3 on 5 score. Quick ratio, current ratio, ROE, ROC, everything has been very good. ROE and ROC has been very stable and high. So that is why I gave a 5 score in both these metrics. And lastly, growth consistency. So revenue growth is good, but margins, if we see, it has dropped a bit, as I explained earlier, because the Warren business is contributing more, and there are margins in that business is low compared to our core business. So that is why the margins have decreased. So that is why I gave a 3 on 5 score here. Overall, the score comes out to be 74. And for the valuation and final take, I'll hand it over to you.
So one of the was highlighted was the valuation seems expensive. Face of it for a micro cap, yes, it does look expensive, but have to factor in the growth as well.
So there are two things. One is the potential regarding war in India, but again, it's more of a commodity kind of a business. So as long as there's tailwind, it would grow. But then you need to be on your toes as to when the sector, when the demand supply mismatch closes, then there's going to be margin pressure. The company has grown really well over the last couple of years, like post COVID. Best case, worst case, giving the same sales number. So let's just take worst case for conservative basis. And yeah, I would be more comfortable giving a 15 PE max. Even then, the price target comes to 252, stating 108. So if the growth historical trend continues, the management is also guiding for anywhere between 30 to 40%, and there's a new capex that's coming into stream. So let's see how everything plays. Then this number should be possible, hopefully, but then would suggest you to do your own research if you're entering, because your own conviction. We are just giving you a brief outlook of what's working, what's not. If you have a slight longer term view, the one of the major is it is negative cash flow from operating, and because of the capex, even free cash flow is negative. So let's take the net profit number for FY25, which is 21. So considering 21 and our required rate of return as 25, because I feel is a higher risk. You're taking a higher risk, so you need to be compensated with higher return. And if your holding period is 5 and trailing multiple after 5 years is 15, so the company's earnings has to grow at around 30%, which is similar what management has been guiding as well. So it's at an interesting juncture. Let's see how the management performs.
I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching, and we will see you in the next one. Bye-bye.